Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. Check us out at jazzwealth.com. Well, this is a quick series that we do called FinTips. Real quick, just to teach you something new, usually basic and introductory, and then just let you get back to your life so you don't have to spend hours searching around on YouTube. If I help you in some way, maybe you'll hit the subscribe button. If not, maybe you'll check us out at jazzwealth.com. We're financial advisors. We build and manage our own portfolios, and we take that very seriously. You can see them all on our website. Well, today we're talking to the beginners, and we're talking about dollar cost averaging. You've heard it before. I'm not the first to tell you about this, but what does it mean, and why do you love it? That's what we're really focused on here today. Well, dollar cost averaging is really simply just buying a consistent dollar amount of your portfolio. It could be an individual stock, it could be a group of stocks. For example, the portfolios on our website are made up of groups of stocks or exchange traded funds. And so by you investing in one fund, let's say it's $100 a month that you do, you're buying into a group of stocks or exchange traded funds with that $100. Now we know that every day the markets move up and they move down, but as long as you consistently put that same amount or something close to it into the investments or the markets, as they're moving up and down, that's called dollar cost averaging. For example, if you put $100 into the portfolio, let's say, and you had to pay $50 a share for it, as an example. Well, then you would have two shares, right? $50 for each share. You put $100 in, you've got a total of two shares. Well, maybe the next month you go to put your $100 in and something's happened. The value fell. Maybe now it's only worth $40 a share, and in that case you put the same $100 in. This time you got to buy 2.5 shares, so you actually get a little bit better of a deal. It's like a slight discount. Now, although the first two shares that you bought at $50, that's going to show what we call an unrealized loss. So it's not going to feel good. You're going to see a loss, but you're able to buy more at lower prices. And basically, dollar cost averaging is just that. It means that no matter if the markets are lower or if the markets are higher, that you are going to consistently put money in and grow over time. Sometimes getting a discount, sometimes paying a premium. You do this in your 401k. So every week or every time you get your paycheck, you have some dollar amount or some percentage going into your portfolio, the different mutual funds or whatever you have in the 401k. Well, that's a great example of dollar cost averaging. Now, there's a really interesting thing you can do here, and some people call this timing the market. I don't call it that because we're not timing the investments. We're actually timing our deposits. A lot of our customers, what they'll do is they'll say, when the markets are just chugging along and everything's kind of fine, they're going to invest for their goal. See, we make every one of our customers understand what is the goal that you're shooting for and how much do you need to put away for that. Well, when things are good, they'll just put whatever they need to get to that goal. When the markets fall, they realize the discount. Hey, I could buy more shares at a lower price. And so what happens then is people will time their contributions, meaning what they'll do is they'll add more to their accounts when things fall so that they're buying more and more of those positions, right? As the markets rally and get back up and things are going good again, then what they'll do is go back to the target amount that they were shooting for in the first place. So this I like to call is timing your contributions, not timing the market, because we're going to invest either way, whether the markets go up or down. So what's really, really, really interesting is if we can buy more on the way down, essentially increasing our dollar cost average there. Well, that's basically all I have for you. A really, really simple way to go about dollar cost averaging, and now you know exactly what it means. If I helped you in some way, you're a beginner and you go, I had no idea. I just thought you invest in things and this is what happens. Well, if I helped you, hit the subscribe button. If you're a beginner and you go, I don't get it. I looked at this, I understand what this all means, I just don't want to do it, I don't have time to do it, I'm not interested in it, but I know I need to do it, well then check us out at jazzwealth.com. We are the only financial advisors that will work with you no matter where you're at. If you're just getting started or you're well on your way or close to retirement, we work with all types of investors. We give you the same service as if you had a ton of money and you were working at one of the big companies, trying to do things a little bit differently around here. Well, hey, I hope I helped you. I will get out of your way. Please check out our other FinTips videos. I hope you enjoy. And hey, we'll talk to you soon.
Hey, wait! Before you go watch one of our other great videos, have you had a chance to see our new FinTips videos? They focus on one topic at a time, covering investing, personal finance, and anything that can quickly help you with your dough. Best of all, we'll keep it real short, because we know time is money.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.